Okay, party people, is getting popping. So just picking up from where we left off yesterday, as always, first things first, you want to make sure your chart is set to New York. Secondly, always remember that we are using the 5-minute chart, trading gold, and this is a ICT strategy using ICT breakers. So if you don't understand what are breakers, please do check out ICT's channel. But to keep the videos sweet and short, I'm just going to get into it. The important things that you need to do and highlight on your chart, and how we get into trade and how we exit trades. So first you need to mark off 12 midnight at New York. Secondly, you need to mark 7 a.m. for which shows the beginning of the New York session in the morning. Thirdly, you want to highlight your high of the London session, which is everything to the left of 7 a.m. and draw it out into the future. Once price touches a high or just touches it, you want to bring that line back and mark it right there. Vice versa works for the low. You want to mark the low and draw it, and draw it out into the future. And once price touches that low, you want to bring that line in. And then you always want to mark out your previous daily high and draw it out into the future, as you see I've done here. And then you also want to draw the previous daily low and draw it out into the future. If a high or low has not been taken in that week, you want to keep on drawing it out into the future. You can do that always, but I always like to focus on the week so that I never stretch my take profits too much and just don't aim for, something that is possible, but maybe it's going to happen tomorrow or the next day. I'm focusing on what can happen today. So first things first, remember we are using ICT breakers. Quick review. What are breakers? Any pattern that looks like so. Where's the break? The break is here. This is called a low. This is called a lower low. This is called a break in market structure. Vice versa, everything I'm showing you this way can be switched around. What do I mean by that? A high, low, false high, break in market structure. Where's the break? The break is right here. Price breaks down, and breakers don't always need to be a high. Sometimes it can be a high, false high, and a break in market structure. Vice versa works for it being bullish. Low, false low, break in market structure. And they will come in variations on the chart, obviously. So right here we have a break. As you see, I've marked that out. This is a trade that I was in yesterday. You can check that out on my shorts. This exact trade, I marked it with the date, February 7th. Today is the 8th. So that's a high. So that's a low, high, low, high, lower low, break in market structure, retracement, break in market structure again. That just amplifies for me, from my perspective. So what I just drew out for you, where it looked like it's low scribbles, this is actually it. So remember I showed you low, high, low, high, low. See, there's actually another high there, then there's actually a low. So everything you see on a higher time frame is going to be more fractal. What do I mean by fractal? It's going to be more broken up. There's going to be more bits. So the high was taken there, another high was taken there, another high was taken there. If you're looking at the 1-minute chart, you want to see multiple highs being taken out for you to even think about being bullish. Same thing works vice versa for being bearish. You want to see multiple lows being taken out on the 1-minute chart. But there's a reason why I focus on the 5-minute chart first, just for you to get your bearing and get used to it. And the more you get into price action and how it prints and how it looks, the more you understand it, vice versa. So we get that break here. This fair value gap is from the 15-minute. I drew that out, and I also drew out this breaker here. So this is how I entered on this position. We're going along. So right there I would have entered. As it touched, boom, I would have had my stop right here, and then I was going to aim. Then I aimed for this high. That's the high I aimed for. So previous day's high, reason being because As price printed, it came back immediately, and I knew we were just coming to grab on something. We were coming to this order block here. We traded back up again, traded back lower into this 5-minute fair value gap. I wasn't stressed because on the 15-minute chart we were still bullish. It came in, we traded up, boom, we hit our target, move to the sides, wait for another development in price. So there was another trade available here, but because I'd hit my profit target for the day, I was not interested. But what did we do? High, low, high, false high, break in market structure. It looks weird, I know, not the way that you want it to look, but let's go on the 1-minute chart. What do we have here? Is that not a high? Is this not a low? Is that not a higher high? Is that not a break in market structure? And again, I repeat, price is fractal, so I'm going to draw it out for you here. Price is fractal. The lower you go, price is going to be more fractal. So we get that break, we get this fair value gap right there. You could have entered there, going short, right there, your stop right there at that high. I always like to put it on the high because I don't know what might happen. Price likes to do its, price is price. I can anticipate just for 1-2 moves, but not for everything. So I always give my stops some room to breathe, because I used to do that thing of like having tight stops because I didn't want to lose. But yeah, lose that, it's being stupid, you will lose more money in the end. So stop gets to breathe on the high. We retrace into that fair value gap, I would have put a position. We retrace again to the fair value gap, I would have put another position. If we retrace a bit higher, I would have put another position. If we retrace a bit higher, I would have put another position. And why would you say that? Because, for example, if per trade I'm willing to risk $200, for example, then obviously I'm not going to put 200 right here. I'm probably going to put 10 right about here, because by the time I drag my stop up to there, it's going to probably be like 60. And then if it goes a bit more in, I'll put in another position. And then by the time I drag it up to there, it's going to be like 40. And then let's say that it digs a bit more and I put another 10. So by the time I put it here, it's going to be like 25. So altogether, approximately, I'm risking like $110 to make what? Probably, let's see, from there, boom, man, that's like $600-$700, like maybe. I'm just, I don't know. My math might be off, but for risking 4.3 to make 7.87, that's a 1 to 1.7, 1.8 ratio. So so you basically, from what I risked, I would have made, let's see, so if I risked $150, I would have made 150 plus some cheese, so $200. So yeah, not the greatest example, but you get my drift. Maths is not my strong point, I just understand this. So okay, cool. So that was the move. Boom. It took some time. As you see, as long as your stop was there, you're going to be cool. It did retrace, but we eventually hit that mark and we went even lower. So that was going to be your execution. So for example, let's say that you had missed this move here and you had caught it coming down here, and you say, oh snap, there's no fair value gap. What do I do? What I do is I measure the break move, and half of that is consequent encouragement, or mean threshold, if I'm not mistaken. This order block here becomes mean threshold, or this breakdown here becomes consequent encouragement. As price retraces up halfway into that point, at 40% I would have hit it. Usually ICT uses a Fibonacci, but mine is not set, so yeah, I use that tool there. It shows me half, and as soon as price gets to 40%, I would have entered my stop right there. It came again, I would have entered my stop right there. So if you don't understand that, and you understand that price is printing down, making a high, printing down, making a high, printing down, and finally breaks. These candles here, I treat them like bearish propulsion candles because they are connected. They are still within this order block here. So for me, that's still an order block. I still treat it like an order block, but that comes with time and understanding. But I'm just going a little bit into the details of ICT concepts and how I perceive them and how I utilize them. So yeah, so we came in right there. You could have went short again if you had missed that first opportunity. So there's always a way for you to go short appropriately, you know. Don't just see a break and then wherever it is, shit, okay, cool, I'm gonna get into this move, it's fine. Nope, you'll get burnt. Do not do that. There's always a place for you to enter. And look at that trade. That was a handsome trade if you were in it. Even from there, from entering from there to there, that was a handsome trade. But entering here, look at that risk, 1.3 to, so that's a 1 to 6, you know, risk reward. That's a great trade in my book. And then that was it for the day. 2 trades. You day trading. It's not a game. Don't think that you're going to be on the charts just pressing button, click, 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 click the whole day. You want to master your strategy. So again, the strategy works. The strategy here that I've mastered and find my edge works from 7 to 11. That is where I'm looking for my opportunity, and that is an ICT kill zone. Again, I did say this is an ICT strategy. So it's nothing new under the sun, but people teach things in different ways.